Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate documents into something you can actually understand. Today, we are diving into the CLOROX company. Get ready, because we are about to see if CLOROX is cleaning up in the market or if they are the ones needing a good scrub down. We are looking at an 8K filing from March of 2025. An 8K is like a corporate alert system. It tells investors about major events that could affect the company. In this case, CLOROX is announcing a big change to its credit agreement. The main event is that CLOROX just signed a new credit agreement for $1.2 billion. Think of this agreement as a corporate credit card with a very high limit. This money is unsecured, meaning CLOROX doesn't have to put up specific assets as collateral. The banks involved include JP Morgan Chase, Citibank, and Wells Fargo, which are big players in the finance world. This money is for general corporate purposes, which basically means they can use it for anything from buying new equipment to funding marketing campaigns. At the same time, CLOROX is getting rid of their old credit agreement from 2022, which was also for $1.2 billion. Luckily, they didn't have to pay any major penalties to end the old agreement early. It was set to mature in 2027 anyway. Swapping out one credit agreement for another isn't necessarily unusual, but it's good to check that the new one has better terms for the company. It is not surprising that the banks in this deal have existing relationships with CLOROX. These banks often handle various financial tasks for CLOROX, such as managing their short-term debt, helping with currency exchange, and providing advice on investments. The agreement comes with some strings attached. There are standard rules about what CLOROX can and cannot do, such as limits on selling off assets, merging with other companies, or taking on too much debt. The agreement includes something called a consolidated interest coverage ratio. This is a financial health check to make sure CLOROX can comfortably pay the interest on its debts. It also lists what would happen if CLOROX fails to meet its obligations, like missing payments, breaking promises, or facing bankruptcy. These are standard precautions to protect the lenders. Now let's talk about the interest rates. CLOROX has two options for calculating interest on the money they borrow. One option is tied to what's called the base rate, which is linked to the prime rate, federal funds rate, and something called the adjusted terms of FAR rate. The other option uses the term SOFR rate directly, plus a little extra. The exact rate CLOROX pays depends on the company's credit rating. Basically, the better their credit rating, the lower the interest rate. There's also a quarterly facility fee, again depending on CLOROX's credit rating. Plus, if CLOROX uses letters of credit under this agreement, they'll pay extra fees for those as well. So what does all of this mean? CLOROX is essentially refinancing its debt. They're replacing an old credit agreement with a new one, likely to get better terms or more flexibility. This move gives CLOROX continued access to a large sum of money which they can use to run their business and invest in future growth. It also signals that banks are still confident in CLOROX's ability to repay its debts. Now for my take, CLOROX is a household name, but that doesn't mean it is immune to market pressures. This new credit agreement gives CLOROX financial flexibility, which is always a good thing in a competitive market. However, taking on more debt always carries risk. If sales decline or interest rates rise, CLOROX could find itself in a tight spot. One potential risk for CLOROX is competition from generic brands and changing consumer preferences. People are increasingly looking for natural or eco-friendly cleaning products, which could challenge CLOROX's traditional product lines. A major opportunity for CLOROX lies in a spot. One potential risk for CLOROX is competition from generic brands and changing consumer preferences. People are increasingly looking for natural or eco-friendly cleaning products that meet changing consumer needs, and by growing its presence in emerging economies, CLOROX could drive future growth. Overall, CLOROX seems to be in a stable position. The company has a strong brand, a diverse product portfolio, and access to capital. However, it needs to stay agile and adapt to changing market conditions to maintain its competitive edge. What is notable is that they closed their existing credit line to open the new one, which shows they are actively managing their debt and may have had reasons to close the old one to open a new one. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Let me know in the comments which company you would like me to decode next.